Most people want to get out of the 9 to 5 and into real estate investing. And then, like you were saying in the beginning, they end up with 2 times what a 9 to 5 is, and they're making way less money. I'm not an advocate of like leaving your W-2. You just have to figure out how to start doing it slowly.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris.
Jonathan Greene, welcome to Truly Passive Income, sir. It's great to see you.
Yeah, you too. Clint, Neil, thanks so much for having me on the show. Appreciate it.
Jonathan, why don't you tell us a little bit about your background? I've been looking at your team that you operate, the agents that are on your team. I know that you're invested in a lot of different states. Give us a little bit about your background, how you got started, and kind of the journey up to what your strategy is now, and all the ups and downs you've been through over the years to get there.
Yeah, that sounds like a lot.
It can be.
Yeah, I'm ready though.
Yeah, exactly. Right. This will be a 5-part series.
Yeah, just on the ups and downs. No, I come from an interesting background in that my dad was an attorney, as was I. But my dad basically grew up with no money. His dad was an alcoholic gambler, so every time he got a lot of money, he would lose a lot of money. But my dad became an attorney, started working for the IRS, and just got obsessed with real estate. And he was just buying real estate from the courthouse steps, in the 70s. And that's how I grew up. I was born in 71, and I was out on the road with him looking at properties probably in, the early 70s. Walked hundreds of houses before I was 18, and learned all about it. And he was an opportunity investor, what I call now an asset hunter. So I kind of learned to do that. We didn't work on spreadsheets. We didn't have the internet. We worked foreclosures, rentals, and he taught me over time how to be a landlord. And I continued that even though I went into a legal career as well. I was always investing on the side, but I was never a high volume investor. I wasn't someone, and still I'm not, who count doors. I never have any idea how many doors generally I have because they don't matter to me. The cash flow and appreciation really is what matters. And I've always been an appreciation investor. And I think because my dad created a situation where I could be, so I didn't have to actively search out cash flow. And I think that's an important distinction to make. And then over the years, I actually ended up getting into on-market real estate about 10 years ago after a career in law and art and teaching. And that's kind of propelled this new version of we work with hundreds of investors. And that's kind of part of my own journey is I've backed off investing just because the last 3 years have been crazy. We sold a lot. And now I'm still waiting for deals to make sense to me. And I've started finally at 53 now, investing in syndications, which I believe to be the only truly passive income.
Hey, throw our tagline in, you get bonus points.
Yeah, I know what I'm doing.
Checks in the mail.
Yeah. Jonathan, so you mentioned investing for appreciation, which is really, most young investors, everybody's after cash flow. You're chasing cash flow and looking for that financial freedom, even at the risk of achieving it and just creating a job for yourself, right? Being a property manager or locking yourself into you're getting cash flow off of deals that only work if you're the manager and they don't pencil if you turn it over to somebody else. You mentioned that you were able to skip past that to appreciation. And we all know that appreciation has created more financial independence and generational wealth than cash flow ever will in the history of the world. Like that one piece of property that just appreciates for whatever reason, development around it or Amazon distribution center down the road, or, a new interstate goes in, whatever it may be, creates so much more wealth than cash flow ever will. It's interesting that you kind of got to skip that because you had a base to work off of and move forward. Neil, hold on. This is a cuckoo clock. I've been down this road before. It'll stop momentarily.
It's over there. Yeah. Yeah. It's like 02 on the hour. I must have set the time wrong, but I don't have birds. It's a cuckoo clock that goes off. Clint was the first time he was like, what's happening? Do you have birds flying around?
This guy's, he's done so well with real estate. He's in the rainforest right now.
Yeah, I am. This is a fake background and I'm just, sitting in meditation position in the middle of the rainforest.
Yeah. Well, let me ask a follow-up question on that is how from the way that your dad invested on the courthouse steps and you starting at such a young age, how the asset class that you've invested in, specifically looking for appreciation, Now you're in syndication, but tell me about, did that asset class change over your career of investing, or was it always single family or multifamily or apartments or commercial, or what did that journey look like?
Generally, I've always been a single family investor. I don't think we've ever actually we've owned commercial properties, which I like actually more than multifamily. For my clients, I love multifamily. It's a great option and obviously was more popularized when house hacking became a thing. But I was always a single family appreciation investor. Single families get the best appreciation and you have the most scale if you know how to buy right. And you're what I call like a neighborhood investigator and you know which parts of the neighborhood are up and coming. And the funny thing is, you won't find this on a ton of podcasts or on, at seminars, but I've probably made the most money across the board all on homes that I've lived in. It's because I'm a really good buyer and I know how to do renovations. And of course, I turned into a house flipper, but never a volume house flipper. But I know how to buy, I know how to renovate, I know what's going to make money, and I know when to do it. So sometimes I do what's called back flipping, which is I live in the house for whatever, 5 years, and then I leave and then I fix it up when I've gone to buy another house already, because then I already have the appreciation. If I needed the money, I could pull a HELOC just to do it. So anyone can do it. I just pay cash for the renovation costs, which makes it go quicker.
Jonathan, as Clint hinted, so many investors, when they get in, they're chasing cash flow. And we see it even with syndications. People are always, well, what's the cash flow? What's the cash flow? What's the cash flow? And it's like, okay, well, that's great. But if we hand you back double your money in 5 years, and then, okay, we're going to continue, we're going to hold the asset, we're going to continue to cash flow, but it's not going to be this huge amount of cash flow, but we just doubled your money in 5 years. And it for me, I always think of cash flow as that's what keeps you alive. That's what keeps the asset paying for itself while the appreciation does its work. And as you say, you're either counting on the natural appreciation, you're as you call it, back flipping, where the natural appreciation has sort of happened, and then you're able to sort of go back and renovate it and pull money out of it. But it's that forced appreciation often that does so much of the work, correct?
Yeah, and even unforced. I mean, there's that famous quote, don't wait to buy real estate, buy real estate and wait. And that's what I did. I mean, a lot of those houses, why I do backflipping is they're nice when I move in. They need some stuff, but I can live in it fine. When my kids were younger, like we don't have to have a perfect, house. And then after I do it because I have all the windfall, and then I get an extra windfall because I'm renovating into a hotter market. And I think one thing that helped me also was that I never, because of the way I grew up, I never had an emotional attachment to real estate. So like if the market's good, I sell my house. I don't care. It doesn't make any I mean, maybe my kids, it was a little bit more difficult, but that's how I grew up with my dad. Every time the house was perfect, I had a full court basketball court, and like a pond in front where we could play hockey. It was like, oh, we're selling. And then he'd tell me how much money we're making. And I'm like, okay, this starting to make sense here.
Yeah. Same. My wife and I moved the first 2 years, like live in a house for 2 years. So no capital gains, move on to the next one. We did that 4 times in the first 8 years of our marriage. We just built a house now that we've been in for a year and a half. And Abby came home the other day with plans for a piece of land she found we're going to build, and we're going to wait till September and sell this. And at the end of the day, I got 2 young boys, and like part of you wants to create a home, but the other part of you is like, you're creating so much opportunity. There's a couple $100,000 in equity. It's just a house. The home is the people that's in it. Move on. And there's 2 trains of thought there, but I get it. I mean, once you're trained to think like that, it's hard to unthink that way.
Yeah, I mean, obviously, with kids changing school districts, that's an issue. But if you're in the same school district and the next room is better, they don't care. I mean, if your next house is cooler, they're going to be fine with it. It's just kind of adjusting. And I think I understood that when I was younger. We would move to a house and then we would start to renovate, and then we would have the same things that we had. I wanted to go back though on one thing, because you guys were talking about the cash flow versus appreciation thing. And we both know, if you're obsessively after cash flow, great. You're going to end up buying D to D plus properties. They cash flow for a reason, because they're hiding a bunch of maintenance, and they usually have difficult tenants across the board. So like you were saying before, Clint, that's going to sign you up for your second 9 to 5, which you're not going to handle. Then those are the properties that most people can't handle. And that's the least passive investment possible, is multifamily or apartment buildings in DT plus areas. Because if you have to pay for property management, you're going to pay a lot. You're not paying, 10%, because nobody wants to manage those properties.
That's a very, very good point. That's a lesson that I learned the hard way over about an 8 or 9 year period. So if I knew you then, you could have saved me almost a decade of heartache. Let me ask you this, and I'm not fishing for an answer here, but everybody has a lot. We've seen a lot of people have a different journey and kind of end up. You said you're now investing into syndications, but traditionally you've always done single family homes. You have an understanding of that that's like a generational understanding from watching everything. You basically learned everything that your dad learned through his career. You picked up right there and kind of kept going. So from that single family journey and then into a more active career of selling properties, how did you end up on syndication? And are you still looking at the same type of assets with what you traditionally have looked at in the syndication? But kind of why are you looking at and willing to kind of give over the decision-making ability when you've been so good at that?
Yeah, well, think of it like this. I mean, I think everybody who starts in real estate investing thinks that they're chasing financial freedom, but what they're really chasing is time freedom. I pretty much achieved time freedom. I don't have to do any of the things that I do. I really am passionate about what I'm doing in all aspects of real estate. So for me, I'm looking for more avenues where I can find an operator who I trust. And like you were saying before, Neil, I don't care. I'm glad when I get a monthly check on the syndication, and I'm just invested in my first one now. But I'm after the long haul because I'm patient. And the problem with real estate investors in general, and the way that all of the marketing goes out to them, it's like quick buck. And real estate is like not a quick buck. That's how flippers lose all their money. I'm a really good flipper, but I'll flip 1, 2 a year, lately less because there's nothing to do. But I'll make 180 or 200K on a flip because I know how to buy the house. I know what to do. And I know how to leverage the relationships I built in the on-market business. I buy most of my deals off the MLS because the wholesalers in my area are a disaster. The numbers don't even come close to working. And the problem, so if you just take this, and other people may have this problem across the country. I'm in New Jersey. We've been like a steaming hot state for real estate for years. I mean, like 20, 30, 40 bids for regular home buyers. And the problem now is that all of the investment properties are being looked at by single family home buyers who have terrible agents who give them bad advice and tell them this isn't that big of a renovation. And those are the homes that I used to buy to renovate. But I can't buy them because I'm going against people who are going to pay way more than me. I'm 100,000 lower than them. And I can hear the conversations when I'm on the showings with an agent saying, yeah, the basement looks okay. And I'm like, I mean, are you kidding? There's a structural problem here. It costs like 27 grand. I know this. They don't know that. And I think so that's why I've really taken my foot off the pedal and just kind of relaxed into looking into what really is truly a bit more passive, which is syndications. And like you were asking before, the asset class of the first one's a 52 unit in Chicago, but it was built in like 2017. So I'm hedging my bets into the operator who I knew really well. And those are the type of things that I'm looking for. I still like flipping, but I just never want it to be a volume flipper because aesthetically it's fun for me, and it's not aesthetic if I'm, making the same thing in every single property.
Jonathan, you talk about, the houses that you've owned. Once you realize that they've gained a bunch in value, you're like, all right, well, I'm going to sell it. The market's hot. It's time to sell. Well, right now, one of the challenges is, what do you sell into? What do you like? The whole market's hot, interest rates are high, and that's part of what's sort of frozen the market is that housing prices are high and interest rates are high. So are you just, you're savvy enough that you're just buying a distressed property that you're buying into, or what are you doing?
No, I mean, in New Jersey now, like I'm putting out offers every week. There's 30, 40 offers on every home. They're selling for 500 to $1 million over asking. People are going to, oh, that's not true. I will show you the data. It happens in Montclair, New Jersey. It happens in a lot of areas. I mean, they do price low on purpose, but like you're seeing the scale of these things, and cash buyers are at about like 37% of all of these buys. So there's just a ton of New York City money coming into my area. So for my area, I could turn and sell. I'm finally in a place again where I am now, where I'm comfortable. I moved out of a busier area. I'm in a more rural area of Morris County. My taxes are half what they used to be when I was in Essex County. So I'm very comfortable. I have no need to sell now, even if the market was good. It doesn't propel me because, like you were saying, I don't really need to go buy into a new rate myself. And that's where single family home buyers who own a property, but they need a new property are really stuck. They're sitting on a 2.75 rate. And to sell it, they do great. But like you were saying, they need to buy back in with a 6.75 and also upgrade and be in competition against 30 other people. So it's a very difficult market where I am. And of course, I'm looking out of state. I've been an out of state investor for more than 30 years. But a lot of those were short-term rentals, and we were doing short-term rentals more than 20 years ago in different areas before Airbnb existed. I still like that model, and I like the new midterm rental model. For me, it's just an active management thing and, where the deals are. So I think one thing that's important that goes to the question that you just asked me is a lot of people will just look at real estate and they'll watch the news and they'll see like, oh, nationally, like it's a tough time. But if you don't know your local market, you're never going to be a good investor. And every single town is a different market. So for somebody to say like, it's not going well, Topeka, Kansas, or Evansville, Indiana, or Salem, Oregon, like these are all completely different markets that don't comply with what's on the national news, because that's all fake, anyway, from either side. It's not correct. So I think that's what's important. If you're a brand new investor, or if you're savvy and you want to investigate a new market, just figure out everything about the market and look in places where you're going to find information on where the development is, the action plans for towns. You'll know way more than any investor who's just kind of taking a brief look at Zillow. And I think that's where the play is. People get scared off by headlines and, short-term rentals are dead and investing is terrible. I mean, the multifamily is in trouble, but there's still people buying multifamily because they're buying it from the people who are in trouble.
Yeah, big time. So let me ask you this. In terms of real estate, you've pretty much done it all. You know the ins and outs. You're in your market better than anybody else is. You're not getting pulled up. And when everybody else is buying high, that, it's the time to just sit back and wait for something else to change. But your podcast is called Zen and the Art of Real Estate. And so I think it's one of the things that I found very interesting is that a lot of the conversations are deeper than real estate or about things that are bigger than real estate. One of the things that I love about hosting a podcast, I'm not particularly good at it. Neil's great at it, but you get pulled upwards by the people you get a chance to talk to. Like you're sitting here giving us, 30, 40 minutes of your condensed life experience and everything you've been through, and you're transferring knowledge that you got from your dad, right? And it's like, that's unbelievably powerful. With the podcast that you do, Zen and the Art of Real Estate, like what are some of the things that you try to focus on that are bigger than real estate? What are some of the things that you may have learned from that? And like, I find that I'm being shaped by the people that we get a chance to interact with in a very meaningful way. I'd really like to hear your perspective on that, specifically with Zen and the Art of Real Estate and the focus that you try to have on some things that are bigger than just the nuts and bolts of real estate.
Yeah, I appreciate that. I mean, I think I went through a personal journey in my 40s that was spurred on by being too focused on business. I was sitting at my dinner table with my two kids at the time. I had been divorced for well more than 10 years at the time. And I remember a client called and needed something. And I said, oh, I have to take this. It's important. And like, right when I said that, I just was like, that's the stupidest thing I've ever said. And the next day I deleted my team with my partner, gave her the whole team, quit real estate, put my license away so I couldn't use it on purpose. And all I did for a year was work on myself, personal growth. I was still looking at investments, but I was just trying to get into a more mindful place. And that's what eventually led to this podcast. I actually started during that year 2 other podcasts that were not based on real estate. And when I came back, I wanted to create like a mindful approach to real estate investing, because if you look across the board at what's being advertised, on social media, it's kind of ludicrous. There's like babies advertising like that they can help someone scale to 100 doors when like they literally don't know anything. Not everybody. There's some really great advice out there, but I still think that the pull of modern advertising is making even smart people like overdo it a little. And I've always just been someone who just gives out information for free. I could care less what happens. But like this, you were talking about this medium, the medium of podcasting, so amazing because we can have this talk. Someone, like you said, could just hear one thing and it may change their journey. We'll never even know that it did, but it's possible. And knowing that it's possible is why I have mine. And I'm sure part of the reason why you guys have yours. It's like, you just don't know the impact that you can have. And why should I keep all this information to myself, especially when I'm like always been known as a no nonsense, straightforward, no BS type of person. So, when I kind of started getting back into trying to help people with investing, I would just go in the forums of Bigger Pockets and answer questions. And I still do 10 years later, because like the stuff that's being put in there, like the answers, some of them are just idiotic. Not all of them, but like not everyone's doing it for the right reason. So I've always considered myself like a voice of reason. And that goes to what the podcast is. It's digging deep on what people's whys are, why they do it, how they did it, what they're looking to do, and how other people can take just like a little bit more of a relaxed approach. Like, stop worrying about doors. What's the obsession with doors? If you have 100 doors that are all only cash flowing $100 each, or 10, let's just say 10 doors that cash flow $100, one furnace breaks in one of those 10 doors, and you're not making a profit on all of them for like 4 or 5 years. So like, what's your 10 doors worth? What if I have one door that's a short-term rental and it's making like $7,000 a month? I'm doing better, and I have one door. It's a vanity metric. And I think that's part of the reason why people are falling prey to that.
I want to get you to expand on something you said, because I have a feeling there's a good story behind it. And you said mindful real estate investing. What do you mean by that?
Yeah, I think more focus, less ego. A lot of real estate investors are, fueled by ego. I want to get this. I want to get that. I want to drive a Lamborghini. I want to tell everyone I have a plane. Yeah, that's fine. Like, if you have like all that money, that's great also. But not everyone who drives a Lamborghini paid cash for it. A lot of those are leased because it looks good. And no offense, like if you like Lamborghinis, like go for it. It's not, I don't care either way. I grew up with a dad who was more like a millionaire next door philosophy. Like my dad, he liked houses and cars. Everything else, he was so cheap. That's just how he was. So he would get out of his nice car and he would have on like just like tennis shorts and like a tank top. And everyone's like, who's that guy? I'm like, what do you mean who's that? That's my dad. They're like, that's your dad? Like, they expected him to like get out in like a coat and an ascot. And the thing is, I grew up in a way that nobody still to this day, they don't know how many assets I have, how much money I have. Nobody knows anything, because I don't care to tell anybody that. It's not like, if I can go on a podcast, people are going to be able to hear me and like, okay, that guy knows what he's talking about. They don't have to like me, but nobody's going to say I don't know what I'm talking about. That would be silly. And that would be their ego being fighting against themselves, instead of just being like, oh, I don't particularly want to do his strategy, but he clearly knows what he was talking about.
I've fought that battle myself. Like, I'm a very competitive guy, and I have an ego, and so I've
Me
number
too.
of the most of us are on some level, right? But
some would claim I have a giant ego. I just don't agree.
I think most people would say the same thing about me, and unfortunately, I have to agree. But it's something. It's the older I get, I am constantly being humbled, and I think that's a good thing. And it's eventually, I think the people you surround yourself tend to kind of rub off some of the rough edges if you allow them, and life will do that too. But I've been caught up in like the number of doors and where the property is and what it looks like and everything there. And I think that part of the journey is hopefully getting to the point where doesn't matter about stuff. It doesn't matter about numbers. It matters about the quality of life, the time that you spend, and the places you go with the people that you love. But that's something that sometimes is easier said than done. That it takes a while to get there.
Sorry to interrupt you, but I think like one place that it comes for, it really depends a lot on how everybody grew up. I found that a lot of people who didn't grow up with a lot of a scarcity mentality, so their like will to get more is almost like proving their parents wrong or something like that. Especially for people who came to the country and their parents wanted them to do something else. They got into real estate investing. I had a lot of guests like that. And they're like, in the beginning, I was just trying to prove that I could do it. But I have a healthy ego, but I think there's a difference between confidence and like egoism. And I think that people with very like kind of weak self-confidence, they think everybody is an asshole, just because they're doing well. It's okay to do well. I'm not out there telling everyone what I'm doing. But even if somebody is, I can just shut off their channel. I don't have to like be mad at them. I don't have time for that. And I think the older that I get, And the older my kids get, the more I realize like almost none of this stuff matters. You know, my job is to provide for my kids. Real estate is a great vehicle for me to be able to do that. But I also had to learn, like, I better really be passionate about what I like. Most people want to get out of the 9 to 5 and into real estate investing. And then, like you were saying in the beginning, they end up with 2 times what a 9 to 5 is, and they're making way less money. So I'm not an advocate of like leaving your W-2. You just have to figure out how to start doing it slowly. But people want everything too quick. You know, that's why microwaves were invented. When, I mean, honestly, it will cook on the stove in not that much longer.
Let me ask you this: that this is that tickled me. This is not something that we ask everybody, but I think the way that you're talking about this and being mindful and putting your family first and is it's not something that comes naturally, especially to a lot of younger real estate investors. So, do you have recommendations for books, contents, or the types of relationships that you should be looking for, or the types of conversations you should be having with people around you to put people in a situation where they're looking at things that have greater significance than just money or real estate success?
Yeah, there's one book that I think probably nobody's heard of that my preferred attorney, Ashley Molson, recommended for me. It's called The Wealthy Gardener by John Soforic. It's about real estate investing, but it's also about gardening. And it's a very, very mindful approach to it. Definitely one of my favorite books. I'm so thankful that she recommended it because her and I think the same. And I think a lot of the books that I read are on mindfulness. Zen and the Art of Happiness by Prentiss was like a big life changer for me. And in that book, it just goes down to literally one part in that book. I can see you nodding, Neil, so you're going to know this part. Prentiss is walking in the woods with his son, and he falls into a well, and he breaks his back. And he's lying at the bottom of a 20-foot well. He can't move at all. And the first thing he thought is, I wonder what good is going to come from this. And when I started to act like that, instead of the way I used to act, which was rigid, I was a fighter. I was a trial attorney for 10 years. All I did, I was a prosecutor for 7 and a criminal defense attorney for 2. So all I did was argue all day. And it took a toll on me. And it's hard to come home from fighting over life sentences and all of these things and then like play with babies. And that's why I left that job. And also it's a whole perspective thing. So, my mom passed away when I was 20. My dad passed away at 33. So this is part of my job to take on his legacy. I mean, my podcast, I talk about my dad all the time. And I think that it's important. I didn't have as much time with my mom, but my dad would look down and be like, wow, he turned this into something different. Because this wasn't like my dad wouldn't have had a podcast. He was like very, under the radar. But I think that's what I learned from him. And I think that the mindful approach and things that I can take from books, it's like I do read all the real estate books because I get a lot of good tips out there, but I'm trying to balance those with more books on mindfulness that can really change the way I look at the overall scope of things. So like you said, if I see a shiny object, somebody like me is like, it's of no interest to me. Like I have other stuff to do and I have a focus. I have a laser focus. It does help me get through, but I had to work to get there.
My dad was a terrible real estate investor. Like he would tell me, he was one of the world's worst landlords. They got into it in the 80s, basically when it was the tax break for people with high incomes before the tax code changed. And, he was always having to chase his tenants for rent. He drugged me. I had a very different experience, Jonathan, as far as, the joys of landlording. He would drag me to the properties and I'd have to help him redo the roof or, do the maintenance. I mean, it's just all terrible. And so it was very funny when I started getting into real estate. He kind of rolled his eyes and was just like, oh God, what are you doing? And of course it was, I didn't get into it until, mid 2000s. It's a very different world then. And I'll never forget, it was a very moving moment for me when I had gotten him into a multifamily syndication and it was going well. And we were sitting down somewhere and just out of the blue, he said, pretty smart at this stuff. And you're right. You're right. And, but I don't know where I was going with that, but it just made me, when you start talking about your dad, it made me think of it.
Yeah. I mean, I think think we always want to take from our parents and then do better and make them proud. And I think you were talking about how you used to go to properties. My dad was just an unusual bird. He was way, way ahead of his time. He did used to drag me to the properties, but he dragged them to me so I could meet the tenants. So I knew all the tenants in every single building, commercial, all of them. We owned this one building where there was an electronics store, and we would go there every time he picked me up on the weekend, and I would just get a video game. But I knew the tenants. And so when I came home from college, actually at the end of high school, when I would be there for the summers, or in college, when I came home for the summers, I always worked in my dad's law office, and he would just put the ledger on the table. And he's like, well, here's the rental ledger. There'd be 10, 15 properties on there. And I'd say, well, how come there's no marks? He's like, well, they haven't paid in 6 months. I said, well, what are you doing? Like, how does this work? I don't understand. How are you supposed to get money? He's like, well, I'm nice. They're struggling. If you can get the money, I'll give you half of it. And I was like, this sounds great. So I started to figure out, one, it's not that easy. And two, you can't treat tenants like, hey, just give me the money. They don't have the money. So I actually figured out a way to start having them pay weekly so they wouldn't spend their income. And slowly over time, we got their money back. So I ended up with a bunch of video game money for myself. And my dad was definitely a teacher. But I also had no rules growing up from my mom or my dad. I just didn't really do anything bad. I just was let loose. And I think I was in that context, I was also let loose and available to be involved in real estate from 5 years old or younger on, and money. He was free to tell me like, hey, try this out. He put money into an account at Merrill Lynch when I was like 16. And he said, buy some stocks, talk to their broker, buy some stocks. And I ended up making a lot of money. And I was like, I was just buying stocks that I would do research. There was no internet. I used to look through the newspaper like a box score, and I would look at the companies that I liked. And I started to figure it out at 16. I was doing this, like, of course, like in my bedroom, because none of my friends would be interested in this. They all wanted to go play more basketball. But these are the things that he made it open for me to talk about money, which is, I think, where a lot of people struggle. They have a bad relationship with money, so they want to hoard it. And then when you hoard it, you end up making bad decisions because you're trying to get too much too quickly.
Isn't it amazing how those lessons, even when you're really young, stick with you? That's, my wife and I were married for 7 years before we had kids. And now I've got a 4-year-old and a 1-year-old. He's turning 1 this Saturday. I think about that a lot. So this is a really cool conversation to have, hearing about, it's very formative early. And that, I think we don't talk about that stuff nearly enough. Not because, we care that much that our kids have that much money throughout their life, but it does create options and choices. And I think most people fall into a trap of trading the best years of their life to somebody else in exchange for money so they can buy things just to keep food on the table, So you hope that you create a situation where your kids can be successful enough that they have enough money to have options and a freedom of, like, an independence of purpose where they can choose what comes next. And then you just hope that you've instilled enough character and morality that they make choices that are best for them, best for their community, best for the people that they love and around them, and don't just turn into a degenerate, which is my hope. But yeah, that's the goal. What a cool way to share you two guys having those lessons very early from your dads. That is still something you think about and talk about now. So I appreciate that.
Just think about the title of your podcast, Truly Passive Income. I mean, what people are really tracing, again, is it's time freedom. They want the passive income so they can do what they want. So the money's making it on the side. And what do you want the time for? Hopefully it's not to go out and party. Like, most people are chasing it because they have kids and a family that they like to spend more time, and they're trying to stop trying to get out of the grind. So, your goal really is around family, even if, like, for someone who doesn't have kids, they want to spend time with their parents. Because if you take from my lesson, they're not going to be around forever. You never know what's going to happen around the corner. And I think, again, that's part of my journey in mindfulness. And you have to make investments that are assets. So I always call myself an asset hunter because I'm looking at the asset. I don't use spreadsheets. I only use them when I'm flipping just to see how much money I could make. But I'm not chasing that. I'm chasing an asset that I look at and I'm like, I really like to own this. This house is cool, or this has potential, or this is going to be a good rental. But it has to be something with multiple options that I can do and always appreciate. Again, and I was fortunate enough not to have to chase cash flow, because my dad built up enough for me not to have to worry. And I've definitely done that for my kids. But it doesn't mean that you should make bad investments because of cash flow, because we already told you the horror story of what's going to happen. And 9 times out of 10, that is what's going to happen. You're going to get a second job and you're going to get a bad property. And look, there's very good D to D plus investors, but they know what they're doing. You know, they know that they are going to force appreciation, like you said before, and they know how to do quick rehab. They know the contractors in those neighborhoods who are willing to go into a D plus property, knock out the rehab quickly and get out. But you can't just do that from afar and think like, hey, I have 50,000 to burn, you know, let me just invest in Detroit. And nothing against Detroit. Detroit's a great market, but just like Philadelphia or other cities, you better know what you're doing. It's a block by block thing to know where things are changing. And if you don't know, someone's going to sell you on a quote turnkey that is on the wrong block, and you're never going to make any money.
Yeah. Clint and I often say, we say this over and over again, that in order to be a successful real estate investor, you have need a combination. You need some of these things. You need time, experience, and money. And often people have got money, but they don't have time. And without time, they can't get experience. And that's the kind of people that get sold on, hey, buy this turnkey in Detroit or Memphis. And hey, there's some great markets in Detroit and Memphis, but you don't know. You don't have the experience. You're trusting someone else to say, oh yeah, it's a great deal. When they're incentivized to sell you the house, to just sell you the house and then maybe get out of it. And then maybe they're handed it off to some other schmo to manage it.
Yeah. The one thing I'd add to that is mindset, because I think you can have the time, experience, and money and still have just a bad mindset, and you'll lose money and you'll make bad decisions and you'll burn business partners. You know, or you're so busy, like you said, you're going to give up a little bit too much control. It's like people who do an out-of-state flip and they've never done anything. Like, do you really think the contractor is going to show up? Are you silly? Like, they don't know you. They know you're 2,000 miles away. Like, they're running with the money. Like, just be smarter. You have to have a whole team on the ground. And it's just, you know, modern marketing has changed things. It really looks good. It's the same even for syndications, which again are really passive, but like, you better vet the operator. I'm much less worried about the actual asset in those, because I'm trusting the operator that they have all these other people putting money in. And it's not to say that new operators can't do well, but like me personally, I'm not going on a first time operator on a syndication. Like, I want a track record and I want to know that they've had at least a modified failure. All of us in real estate have crapped the bed at one time, and those who tell you that they haven't are lying, or a big one's coming, a really big one, because they think they can't be beat.
Well, listen, Jonathan Greene, I have so enjoyed this conversation. It was one of the best ones we've had in a while. If any of our listeners want to reach out to you and find out more about what you're all about, what would be the best way for them to do that?
I'm good on the Instagram DMs. That's Trust Greene with an E at the end. And that's my hub site is at trustgreene.com. My team, if people are interested in, we work primarily in New Jersey, but we're opening in Florida now. We're also opening soon in Utah and California, parts of my team. And we do operate in a small part of Nevada and New York. That's at streamlined.properties. And of course, my podcast that Clint was just on is Zen and the Art of Real Estate Investing. We're over 120 episodes. Clint's episode will come out. These will probably end up around the same time. Those are the best way to find me. I don't answer my phone. That's a kind of a thing that everybody knows about me. I call myself the number one texter in the world because I never talk on the phone. I only talk on scheduled calls or Zooms. And because my phone rings 200 times a day with numbers I don't know, because all brokerages sell our numbers to everybody. So it's a time efficiency thing, just like a lot of the conversation we have. But yeah, I'll be in my Instagram DMs enough because I like it. And just on social media, I do whatever I want. I have no content calendar. I say what I want, do what I want, and I could care less what the actual results are. And that turns out to be good results. I appreciate you guys having me on. I had a great time.
Absolutely. Thanks, Jonathan.
Yeah, I really appreciate your time. Have a great one.
Thanks, guys. You too.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.